Welcome to Echo Trade. I'm Jeff Roth, and today we're here with Neil and Max from CM Bidwell. And Neil and Max, as you can tell by the Aloha t-shirts, they're coming to us from Honolulu, Hawaii. So we're here to talk about the CM Bidwell Active Small Cap equity strategy that they're offering on Echo Trade. So Neil, Max, thanks for being here. You got nice tans. I like it.
Yeah, great. Thanks so much for having us. Yeah, appreciate it.
Yeah, for sure. So again, thanks again for partnering with Echo Trade. So we're excited to talk about the portfolio. Hear you guys' background. I mean, you both have, you're looking at decades of experience. I think combined on the investment committee, you got 75 plus. Closing in on 100 years of a combined experience that's going into the portfolio. So, I guess let's dive into the small cap portfolio. Give us an idea, I guess, kind of broadly speaking, and the investors that are watching, what the, kind of the overarching goals of the portfolio. I mean, are we looking, a lot of, portfolios are just looking to generate income, or they're looking to maybe track an index and just, minimize, kind of bear market exposure. But what's the goal of this portfolio specifically?
Yeah, I'd say the goal of this portfolio, it's definitely a growth oriented portfolio. I mean, being focused on the small cap area of the U.S. equities, kind of see it as, it's going to be a part of somebody's portfolio to get a little bit of that more growthy type, smaller cap equities. It would be a good combination with, that large cap index. So we do follow like the Russell 2000, small cap index, but we're not just indexed to the Russell 2000, but that's definitely our universe.
Yeah, gotcha. So basically, and then so small cap being kind of basically just smaller companies versus large cap being kind of the Microsoft and the Teslas and the Apples of the world. So you guys are going after kind of more, like you said, kind of growth focus, where you can have the larger opportunity with smaller companies that have the ability to grow into a Tesla and a Microsoft and getting in early, right?
That's correct. Yes.
Yeah. So, and then you also touched on, the fact that it's probably a good idea to have this as a part of the portfolio, maybe not the only thing you're investing in, and have, exposure to, more of an index tracking portfolio, more, kind of, again, some of those bigger companies in one portfolio, but have this as a more growth focused portfolio with the small companies. Does that sound about right? Or is that a good recap, I guess?
Yeah, no, I think that nails it pretty well. Yeah.
Perfect. And then, so in terms of, the risk factor, everybody's always concerned about risk. How would you guys define the level of risk that's involved with this portfolio versus, kind of others within the small cap space and others kind of, within the industry as a whole? And then kind of what are you guys doing to actually, mitigate and manage that risk within the portfolio?
Yeah, I mean, I guess from just broad asset type, it's going to be on the riskier side. It's it's going to be definitely riskier than your fixed income bond portfolios, at least when you're not getting into the junk bonds and stuff like that.
Yeah.
And it's definitely going to be slightly more risky, a little bit higher standard deviation of returns versus your large cap index. So it's with that growth perspective, it's a little bit on the riskier side, but I mean, it's not, I wouldn't say it's like high risk. Then as far as mitigating, we do, we're not focused on, particular sectors, particular industries. We don't really overweight, too much particular stocks. So we try to keep really well-balanced portfolio, always invested in, the various economic sectors, energy, finance, tech, healthcare. We've got exposure to all that. So when one part of the portfolio is doing well, another part, is not doing so well. We're, kind of mitigating, I guess, the overall risk that way.
Yeah, with a little sector diversification. Yeah. And so, I mean, talking about that, is there certain areas that you guys like? Do you guys like to try to be invested across sectors, or are you guys looking at what's timely, with the certain market conditions or things like, AI coming up, so are you guys invested across sectors, or are there certain things that you guys are looking at specifically that you like at any given time?
Yeah, we try to keep keep diversified across the different sectors.
Mm-hmm.
And so we'll probably talk about it a little bit in the minutes ahead, but we do use a stock model that helps us decide what to buy and sell. And so based on the model, we might be a little bit overweight certain sectors and a little bit underweight other sectors, depending on what's hot in the market. But we typically try to stay pretty well diversified across the different sectors in the economy.
Yeah, and so you're talking about underweight versus overweight. I mean, I guess relatively, kind of a relative term, depending who you're asking. But you know, how much the sector is a part of your portfolio, 50% or 10% or 6% or 5%. What do you guys consider kind of, you know, overweight or underweight?
Yeah, I mean, typically we don't over underweight drastically. You know, like if a sector is typically, if we typically have, you know, based on market cap, we have like, you know, 10 companies in there. You know, maybe we might overweight till 12 or 13.
Yeah.
If, you know, if the model's kind of directing us that way. You know, other sectors, you know, are much smaller market cap. So, I mean, when you overweight, it's like you're going to have like 3 instead of 2 representing that sector. So, but like I say, we don't drastically over or underweight. I kind of view that as, you know, that's kind of tangent to market timing. And I think this year, year to date has shown how difficult that is. I mean,
yeah,
I think there's got to be so many managers that are so far behind benchmarks this year because this year was going to be, you know, doom and gloom and recession and everything. And I mean, we've just had an incredible market this year. So I think in the same way, you know, I think it's difficult to make that call on, you know, energy is, you know, going to skyrocket versus everything else. So we're going to put all our eggs there. Like I say, we'll take a little bit of a hedge here and there kind of thing. But as far as, you know, that previous question on mitigating risk, you know, we think that's kind of one thing that we do in portfolio to mitigate that risk against the benchmark.
Yeah, so you might kind of see the patterns that you guys see with your research that you like a certain sector, but you're definitely not going to take big bets with the portfolio in case that doesn't work out. Like, again, you know, a lot of people, you know, coming into the end of last year, 2023 was going to be, you know, like I said, a doom and gloom year. You know, the market's going to be down, but we've been a fantastic run so far.
It has.
As of this year, as of, you know, summertime, as of, you know, kind of recording this. I guess it dives in a little bit to, I guess, kind of first question. You mentioned, you know, kind of market timing, right? And you're not really trying to do that, but is there a time horizon on the you know, companies that you guys are investing in when you guys find a stock that you like and you guys, you know, kind of purchase that? Is there a certain time horizon that you're looking at to hold it, or that you're looking at certain exit points, or are you just really looking at, you know, kind of an ongoing basis on when you might, you know, kind of, you know, rebalance or get out of the position?
Yeah, go ahead.
Yeah, sure. So we don't typically have a time horizon on how long we're going to hold a position or price targets. The model we use typically will tell us when a stock is a buy, and then it'll typically tell us when it's a sell. So if it comes up as a sell in the model, we'll offload it.
So you're talking about the model. So it sounds like you have some quantitative, you know, kind of factors that are kind of being implemented in the research and the investment process. Can you talk a little bit about the investment process and more about the model that you guys are utilizing that you're talking about?
Yeah, sure. So it is a quant model. It's a model that our founder, I guess, started using back in the day. The firm was founded in 1979. And so this quant model has evolved over the years, but the underlying themes are the same. So there's 3 main factors that go into our model. The first is valuation. The second would be profitability. And then the third would be rising analyst estimates. And so we use a combination of those factors to determine, what stocks on a relative basis to other similar stocks are the best rated in the model. And so we have the portfolio move towards those best rated names, and we keep it diversified across those different sectors like we were just talking about.
Yeah, so you basically kind of utilize the model and the quant model to screen the universe of stocks. I mean, how many kind of symbols do you guys put in, or is it kind of that you guys are screening at any given time? And then I would imagine you're screening them, and then who kind of comes out of that, you're still kind of taking a look on a more manual basis before you make a final decision.
Yes. So there's thousands and thousands of stocks that we get that get filtered through this screen. And then we're kind of just left with a few, a few that are left that kind of match all the factors that we're looking at, and those are the ones that we're really looking at picking up.
Yeah. I'd say that the one nice thing about having the quant approach as opposed to having a more fundamental approach is that, we screen through all those thousands of stocks, but we update that data every week. So, we're kind of taking a new fresh look at all the stocks in the portfolio every week and seeing, what's changed, what's, stayed the same, whatever kind of thing. So, just, having that quant approach, allows for that kind of a, turnover and attention.
Exactly. So you're utilizing the model to have a broad view of so many stocks, but then you guys are keeping your eyes on it on a weekly basis. So talking about specifically small cap, right? So, kind of, you could say historically, I guess, small cap can perform, a little bit better, kind of in times like we're in right now with kind of lots of movement with interest rates and an inflationary environment and economic downturns, which, some say we're in a recession right now. We've been talking about the oncoming recession for a long time. Right. But do you guys see that as the small cap in general, or your portfolio kind of fitting certain market conditions better than others, or you try to make sure that it's able to kind of kind of navigate the waters no matter what's happening within the broader market?
I guess we kind of let the model dictate where to place our investors' money, right? So if the model, because one of the factors that we use is analyst estimates, right? So where the analysts are moving, that kind of helps the model decide like where to move money. So, for example, if we do hit a recession, we might see that analysts would be moving more towards the defensive stocks like healthcare or consumer staples, utilities, or if there is no recession and the economy starts booming again, then we could see the analysts move back to tech stocks and high growth stocks. And so we kind of let the model dictate, like even within certain sectors, we listen to what the analysts are saying.
So you're staying nimble based off of what the model's saying and what other analysts are saying, and kind of
we try not to use our own personal bias. When picking stocks.
Yes.
Because if we bought into we're going to be in recession starting already this year, then we would be missing out on like right now. There's a lot of growth names that are just flying, and so if we were defensive, the model would have. Our portfolio would have really underperformed. So.
Exactly. Okay. I guess to wrap it up, if you guys can just kind of give me an idea of how you guys view the portfolio and how you and your process, I guess, as well with that. Like, how do you guys think it's a little bit different than what's available within Echo Trade versus, kind of the broader market as well, and other kind of, asset managers?
I guess, far as kind of being different, I think basically the small cap area is somewhat of an underfollowed. Definitely, there's a lot more investment opportunities in large cap and the broader market. So from that perspective, I think, like I said earlier, I think it's a nice area to be for somebody to supplement, that mega cap index related, investment.
Yeah.
And then as well for, I really believe, the quantitative approach where, it kind of takes out those human biases.
Yeah.
Because even professional investors get, so caught up in, different behavioral biases in finance and anchoring and so I like the combination of the small cap and the quant as, part of somebody's portfolio.
Yeah, exactly. And I think within EchoTrade, I think I'd have to go back and look, but I think you guys are, if not the only one of the only small cap, focused portfolios within the platform as of today. And so it's fantastic to be able to have you guys having that offering, to be able to offer that very, variety within our platform and get access for our investors. And again, you have, like you said, you have the quant side to kind of eliminate some of the human emotion, which we all have. Yeah. And then the small cap side, which offers, kind of the potential for some, larger growth, versus the more established companies. So thanks for doing this, guys. Really appreciate it. And excited to have the portfolio within EchoTrade, and investors can go take a more, deeper look at the active small cap equity strategy within EchoTrade. Thanks, Neil. Thanks, Max.
Great. Absolutely. Thank you.